Now we start with what exactly is a balance sheet. A balance sheet is one of the financial tools that you're going to need to learn, especially if you're doing fundamental analysis. What a balance sheet really does for you is it shows you what it says it is. It's basically a written record, a balance of all the assets and liabilities you have. It's really pretty simple. If you remember from some of the other lessons that you might have had, like an income statement and so forth, balance sheet is your assets and your liabilities, like your savings and your stock, your mutual funds, CDs, real estate in your business, are all your assets, and all the things that are liabilities that you owe on those things. Take a close look at the balance sheet. We'll notice something. Maybe you have $148,000 in your personal asset column, but the trick is to reduce the liabilities in your personal liabilities column by converting it to a business expense, tax credits, and the like. Every situation is different, so you want to consult a financial advisor or tax advisor for your specifics, but there are some things that you can actually go through, like your mortgage and your school loans and so forth. A lot of those things that you can convert to an actual business expense, so it's taken out of your personal expense that you actually have to pay for by yourself. From a personal income perspective, you try to pay all those things, it might look impossible to actually make more money than you're paying out, but it's the ability to convert that into something that the business can pay for. And you go from there. If you notice some of the real estate mortgages and some of that sort of thing, you have more income than you have more liability than your income. You can try to convert those over to a business expense. Like, for example, if you owned an apartment building that you own personally, you can convert that into a business, and that would take care of that mortgage for your payments. The business would therefore pay for it. That would take some of the income and expense, or that would take some of the expenses out of your personal payment accounts and so forth, and put it into the business responsibility, whereas you would still get the income and so forth from those things. Same idea with not credit cards necessarily, but loans, and like I said, the mortgages and the bank loans and some of the other liabilities that you might have in your personal column. Again, you would want to check on your specific situation with a financial advisor before you really start doing those things, but it can be done if you look at it carefully, and that will save you a liability, and if not increase your income, then certainly decrease what you have to pay. So, for example, as you see here, you have a savings, stocks, mutual, same thing you had up there, but now your total liability and your total assets have gone to a different perspective. Liability column on the asset sheet is reduced quite a bit at that point. And now you have a more equal asset, but you want to still build your assets to reflect and potentially become more than your liabilities, of course. If you want to look at the competitive rates of CDs at the time, you can click on that and you go to bankrate.com, and you can say, look at your different ones here and so forth. So in this case, as of 2010, you looked in Franklin and so forth, you have between $2,500 and $5,000, you make 1.65 to 1.7%. Of course, you can go back to see the current pricings and so forth as of right now. If you want to go into all of that, that's a fixed rate idea of income. That's what they call it, fixed rate income. It's like bonds and CDs and so forth. You have a specific set of interest rate and certain set of time that you get it over like 5 years at 2% or something like that, for example. While assets such as CDs and other things give you money, liability is taken away. That's the difference between an asset and a liability. Anything that puts money into your pocket is an asset. Anything that takes money out of your pocket is a liability. Even if it seems like it might be an asset, it can be a liability if it's taking out more money than it's putting in. Even a rental house can be a liability if it's taking out more money than it's putting in. If you're charging a renter, for example, $1,000 a month and it's costing you $1,100, that's a liability. In this particular case, these are some of the CD rates at the time that we have here. at 1.26%. This is a few years ago, so you might want to check again, of course, to see what the actual rates if you're interested in CDs and so forth. Again, that's bankrate.com. You can check for that. You can see, you notice it's under 1% for most of them, 1.5% for the longer term, and so forth. Not every asset's created equal. Remember that. It depends on your situation. It depends on what you're doing, what your goals are. That's why you have to understand your situation, your personality, and what your written goals for your long-term investing and so forth are. What is your long-term goal? What's your goal for intermediate times and so forth? CDs generally, in my way of thinking, CDs are generally what they call a safe sort of investment. In other words, you have a safe investment, you have a rich investment, and you have a comfortable. In other words, you have one that's just there for a safety net. You have investments that are there to help you become comfortable in your living, that you can essentially pay for your debts and so forth, and pay off your mortgage and so forth. And then you have a plan for becoming rich. Becoming rich is different than simply being comfortable. Of course, you go through this and you say, okay, so basically you have the three types of financial statements for a fundamental. That's what you look at for yourself. That's what you have to understand for, like, if you're investing in a business. You have the income statement, you have the balance sheet, and you have the cash flows. Cash flows is how much money flows in and out of your business or your own personal cash flow. Balance sheet is just what it is here, showing the balance of what you owe and what your income is, what your assets are. There again, we have some of the information of how much you're paying the bank back, how much you have for control. You want to make more money, obviously, than you're paying the bank. So if the numbers work, then your balance sheet will reflect those numbers. As long as you can make the numbers work, yet you're paying more income than you're paying an outgo, you have a good situation. You have a profitable or asset. If it's the other way around, you have more outgoing than you have coming in. Obviously, everybody's familiar with that, right? You always have that more money, more month at the end of the money, the more money at the end of the month. Well, we want to flip that around. And these are some of the ways that you can do that, by understanding those financial understandings of your balance sheet, cash flow, and income statement. So, okay, you pay the bank back $4,796 a month for this building we're talking about. It's $1 million building. Down payment of 20% of $200,000. Your mortgage is $800,000. You have 32 units making you $600 a month. That's $19,200 a month. Of course, you don't get all that money. First of all, it would be all the liabilities that you have for paying for maintenance and so forth, and of course the mortgage would be part of that. Then you have any people that you have paying, like your property manager or any partners that you have in your company and so forth. You do want to use a company to invest. So if you have a total rental of that, say for example your mortgage is $4,796, your expenses are $2,880, you make a pre-tax profit of $11,500, for example. These are just examples. Obviously your situation will be different. But that's the idea behind, is that even if you divide that in 3 or 4,